There's a war in the Middle East. Silver inventories are at multi-year lows. The dollar is under pressure. Every single one of those factors is supposed to send silver higher. Every expert said so. Every silver YouTuber predicted it. The formula was simple. War plus low inventory plus dollar weakness equals silver moon. And then silver crashed over 4% in 24 hours. Okay? Let that sink in. We have an active military conflict between major powers. We have COMEX registered silver at levels that everyone calls critical. We have all the ingredients that are supposed to make silver explode upward, and it crashed. So the real question that nobody wants to ask is this. Were the experts wrong? Or is the entire framework for predicting silver prices broken? Today we're going to answer that. We're going to look at what actually happened in the last 48 hours. We're going to examine why the war equals silver moon prediction failed. And most importantly, we're going to build a better framework for understanding what actually moves silver prices. Because here's the thing, if you keep using a broken prediction model, you'll keep being surprised. And surprise in financial markets usually means losing money. I'm the stat guy. I track predictions. I hold people accountable. And today, I'm going to explain why almost everyone got this wrong, including probably some of the people you trust most. Let's get into it. On Monday, silver was trading around $84 or $85 per ounce. By Wednesday, it had spiked briefly toward $90. Everyone was excited. This is it. War escalation, safe haven demand. Here we go. Then on Thursday and Friday, silver crashed. We saw a drop of over 4% in a single session. Price fell to around $80.50. Some reports showed even lower prints intraday. At the same time, we saw claims, viral claims on social media, that $7.4 trillion was wiped from the metals market. Let me address that number first because it's important. The $7.4 trillion figure is almost certainly exaggerated or misleading. The entire gold market, all the gold ever mined in human history, is worth roughly $17 trillion. The silver market is much smaller. For $7.4 trillion to be wiped out, you'd need to erase nearly half of all gold value. That didn't happen. Gold dropped about 2 to 3%. Silver dropped about 4 or 5%. Significant moves? Yes. Historic wipeout? No. What likely happened is someone calculated total notional value of derivatives contracts and applied a percentage loss. That's not the same as actual wealth destroyed. It's a sensational number designed for clicks, okay? So let's set that aside. The real story is simpler but still important. Silver was at $90. Now it's at $80. That's a 10 drop, over 10% from the weekly high, during an active war with low inventories. That's a genuine puzzle that deserves explanation. Now, what else happened during this period? The stock market also crashed. Major indices dropped significantly. When stocks crash, several things happen that affect silver. First, margin calls. Traders who are leveraged across multiple markets need cash. They sell whatever they can, including silver, to meet margin requirements. This creates forced selling unrelated to silver fundamentals. Second, liquidity preference. In a panic, people sell volatile assets and move to cash. Yes, silver is supposed to be a safe haven, but in acute crisis moments, cash is king. Even gold gets sold. Third, dollar strength. During this period, the dollar actually strengthened. When the dollar rises, silver priced in dollars falls mechanically, even if physical demand is unchanged. There were also reports of COMEX glitches. Multiple traders reported unusual behavior on the exchange. Some orders weren't executing properly. There were delays. Some people are calling this evidence of manipulation or system stress. I'll be honest, I don't know what the glitches were. They could be technical issues. They could be signs of stress. They could be nothing. What I do know is that unusual exchange behavior during high volatility periods is worth noting, even if we can't explain it yet. So that's what happened. Silver spiked, then crashed. Stocks crashed, dollar strengthened. Exchange had issues, war continued. Now let's examine why the predictions failed. I want to do something I call a prediction autopsy. We're going to examine the dead prediction, war equals silver moon, and figure out why it didn't survive contact with reality. Let me break down the prediction into its component assumptions. Assumption 1, war creates safe haven demand for silver. This assumption has historical support. During periods of uncertainty, investors often buy precious metals as a store of value. Gold, especially, silver to some extent. But here's the nuance that most predictions missed. Safe haven demand has time horizons. In the immediate hours and days after a crisis begins, markets are chaotic. The initial reaction isn't buy safe havens, it's sell everything and figure it out later. Liquidity matters more than thesis. The safe haven effect typically emerges after the initial panic subsides. Days to weeks later, not in the first 48 hours. If you look at March 2020, silver crashed during the initial COVID panic. It fell from $18 to under $12. Then, over the following months, it rallied to $30. The safe haven effect was real. It just took time. The predictions assumed immediate effect. Reality has a lag. Assumption 2. Low inventories mean price must rise. This is the COMEX narrative. Registered silver is low. Vaults are draining. Therefore, price must go up because supply is tight. But this assumption confuses two different things: inventory levels and flow. Inventory levels tell you how much is in the vaults right now. Flow tells you how much is being added or removed over time. Price responds more to flow than to levels. If inventories are low but stable, price doesn't necessarily spike. If inventories are high but draining rapidly, price might spike. During this crash, what happened to inventory? I haven't seen data showing massive delivery demands that would have triggered a squeeze. The low inventory existed before the crash. It exists after the crash. It didn't cause a spike because there wasn't a sudden surge of delivery demand. Low inventory is a condition, not a catalyst. You need a catalyst, a sudden increase in delivery demand just to trigger a squeeze. War alone wasn't that catalyst. Assumption. 3. Dollar weakness supports silver. Many predictions assumed the war would weaken the dollar. More money printing to fund military operations. More uncertainty about U.S. global position. Therefore, dollar down, silver up. But in the short term, the opposite happened. When markets panic, global capital flows into the dollar, not away from it. The dollar is still the world's reserve currency. In crisis, people want dollars. Even if they think the dollar is doomed long term, they hold dollars short term. This is counterintuitive, but it's consistent across many crisis episodes. The predictions assumed a weakening dollar. Reality delivered a strengthening dollar, at least temporarily. Assumption 4. Silver follows gold. Gold has hit all-time highs repeatedly in 2024. The assumption was that silver would follow, especially during crisis conditions. But the gold-silver ratio tells a more complex story. Gold has been outperforming silver. The ratio has been elevated. This means gold is acting as the preferred safe haven, while silver is treated more like an industrial commodity. Why? Possibly because silver has more industrial demand than gold. When recession fears rise, industrial demand fears rise too. Silver gets sold on recession fears, while gold gets bought on uncertainty fears. During this crash, gold dropped less than silver. That confirms silver is not behaving purely as a monetary metal right now. It's being treated differently. Okay, so the predictions failed because they relied on oversimplified assumptions. But what's the better framework? How should we think about what moves silver in the short term? Let me give you what I call the silver price reality framework. 5 factors that actually determine short-term silver moves. Factor 1, liquidity and leverage. In the short term, silver prices are dominated by leveraged traders in the futures market. When they get squeezed, margin calls, forced liquidation, prices move violently regardless of fundamentals. Before asking, why did silver crash? Ask, who was forced to sell? If hedge funds were long silver and long stocks, and stocks crashed, they had to sell silver to raise cash. The selling wasn't about silver fundamentals. It was about portfolio mechanics. This factor overwhelms all others in acute crisis moments. Factor 2, dollar direction. Silver is priced in dollars. When the dollar rises, silver falls mechanically. This relationship is strong in the short term. If you want to predict short-term silver moves, watch the DXY, dollar index, as much as anything else. During this crash, the dollar strengthened. That explained much of the move. Factor 3, risk sentiment. Is money flowing into risky assets or out of them? Silver often trades with risk assets, not against them, despite its safe haven reputation. When stocks crash, silver often crashes too, at least initially. The safe haven effect is real but delayed. If the S&P 500 is dropping 5%, don't expect silver to rally. Expect it to drop initially, then potentially recover as the safe haven trade emerges. Factor 4, physical demand signals. This is where premiums matter more than spot price. During this crash, what happened to physical premiums at dealers? If premiums spiked while spot crashed, that tells you physical demand is strong even as paper price falls. If premiums stayed flat or fell, demand isn't as strong. I'd want to see dealer premium data from the last 48 hours before making claims about real demand. Factor 5, positioning and sentiment extremes. When everyone is bullish, maximum long positioning, euphoric sentiment, silver is vulnerable to crashes. The war equals moon narrative had everyone positioned long. That's crowded. Crowded trades unwind violently. When everyone is bearish, silver is set up for rallies. Sentiment extremes are contrarian indicators more than directional predictors. Let me give you 4 lessons from this episode. Lesson 1. Short-term and long-term are different games. The war equals silver moon thesis might be correct over months or years. It was incorrect over days. If your thesis is long-term, stop looking at daily prices. If you're trading short-term, stop relying on long-term theses. Most people mix these up. They hold long-term positions but panic at short-term volatility. Or they trade short-term but use long-term narratives as entry signals. Match your time frame to your thesis. Lesson 2. Catalyst matters more than condition. Low inventory is a condition. War is a condition. Dollar weakness is a condition. Conditions set the stage. But prices move on catalysts, specific events that trigger buying or selling. A genuine physical squeeze, actual delivery demands overwhelming supply, would be a catalyst. War alone isn't. Inventory alone isn't. You need the trigger. Lesson 3, then beware consensus predictions. When everyone predicts the same thing, the trade gets crowded. Crowded trades are vulnerable. Before the crash, almost every silver commentator was predicting higher prices due to war. That consensus meant everyone was already positioned. Who was left to buy? When prices started falling, who had to sell? The contrarian signal was flashing. Most people ignored it. Lesson 4, accountability matters. The people who confidently predicted $100 silver by Friday or war guarantees moon, what are they saying now? Watch carefully. Are they admitting they were wrong? Or are they saying manipulation and moving on? This is how you evaluate who to trust. Not by their confidence, by their accountability. Let me do what I always do. Hold myself accountable. Did I predict this crash? No, I don't make short-term price predictions because my track record on short-term timing is not good. Nobody's is. But I did say in my previous videos that the COMEX breaks soon narrative has failed for 13 years, that the war equals silver moon formula is unreliable, that short-term predictions in this space have a terrible accuracy rate. Those statements held up. The framework held up. The specific price? I didn't predict it. Here's what I'm adding to my tracker today. Prediction 1. The mount manipulation narrative will be cited by at least 5 major silver channels within 48 hours to explain this crash, with zero accountability for their prior predictions. Confidence, very high. Prediction 2. Silver will experience at least one more 5% plus single-day move, up or down, before the end of this month. Confidence, moderate. Volatility tends to cluster. Prediction 3. The war premium will largely dissipate within 2 weeks, unless there is a significant escalation. A major attack on oil infrastructure, direct U.S. involvement. Confidence, moderate. These are logged. Check my tracker. Hold me to them. Principle 1. Don't panic, sell into crashes. If you're a long-term holder for the monetary debasement thesis, nothing changed fundamentally. The dollar is still being debased, debt is still rising. The long-term case is intact. Selling physical silver because the paper price dropped 10% defeats the purpose of holding physical silver. Principle 2. Don't FOMO buy into crashes either. Buy the dip is not automatically correct. Dips can become bigger dips. If you're going to buy, do it systematically. Dollar cost averaging, not emotionally. The time to buy is not when you feel panicked. It's when you've planned to buy. Principle 3. Expect more volatility. This isn't over. Wars don't resolve in days. Market stress doesn't resolve in days. Expect more swings. Set your position size so you can sleep at night regardless of direction. If this crash made you lose sleep, your position is too large. Silver crashed over 4% during an active war with low inventories. The war equals moon prediction failed. It failed because short-term liquidity effects dominated safe haven demand. The better framework focuses on liquidity and leverage, dollar direction, risk sentiment, physical demand signals, and positioning extremes. The lesson: short-term silver predictions are unreliable, even logical sounding predictions, even predictions from experts. The track record is poor. What matters is your process, your position sizing, and your ability to stay in the game long enough for the long-term thesis to play out. I'm the stat guy. I don't promise I'll be right. I promise I'll be honest about when I'm wrong. Subscribe if that's the kind of silver content you want. See you in the next one. Prediction tracker link is in the description. Check the predictions I made today. Check them in 30 days. See how I did. Next video, COMEX glitches. Explained what happened, what it might mean, and how to evaluate the claims. See you then.